Prosperity is more than a number. It's the power to shape what's possible for you, your family, and your heirs. Here, you'll find ideas for building wealth, safeguarding it, and translating it into true prosperity with insight from actual business owners and financial professionals. Welcome to the FDP Prosperity Report, hosted by your Chief Prosperity Officer, Mark Chandick.
Welcome to another episode of the FDP Prosperity Report. I'm your host, Mark Chandick. Today we're exploring annuities, a financial product you've likely heard of. But what are they exactly? What purpose do they serve? And when are they a good choice for including in your financial plan? What's the downside? My guest, Zach Hurst, will help us take a look at the angle so you can have a knowledgeable opinion instead of a knee-jerk reaction when you hear this much talked about term. Zach is Director of Financial Planning for Valmark Financial Group in Akron, Ohio, where he's responsible for design, marketing, and implementation of Valmark's unique financial planning processes, including asset accumulation, retirement income distribution, and legacy planning. Zach, welcome to the Prosperity Report.
Hey, Mark. Thank you so much for having me. It's an honor.
Let's start with something foundational. What is an annuity?
Yeah, definitely a great place to start is by having a client actually understand the terms that we're using in the financial industry. So I'd like to answer that in probably two different ways. One, it would be the technical answer, and then two, I'll give you more of a narrative answer to help your clients understand it. So technically, an annuity is just a contract that's issued by an insurance company. And that contract has the promise to pay out the invested funds either immediately or at a future date. This contract can be broken down into two different phases, the accumulation phase and the annuitization phase, where the client actually receives money back. And all of this gets wrapped around this term we call annuity that has the benefits of tax deferral. So that's like the technical hardline answer to the question. But the easier way that I like to remember it is, think of the annuity contract as almost the opposite of life insurance, a concept that a lot more people tend to understand. So in life insurance, you pay premiums, maybe annually or monthly, to an insurance company at hope that in a future date when you pass away, a lump sum of money will come back to you or your estate or your heirs. An annuity is just the opposite. You are going to pay a lump sum of money, and then they are going to help liquidate that estate over time, giving you money for the rest of your life.
Boy, that's a great explanation. Very clear. Thank you. People can hear the term annuity sometimes and they're completely turned off. Why do you think that is?
Yeah, definitely the term annuity has received some, I will call it negative press over the years, whether it's bad business practices from some not so reputable insurance companies or even other money managers that don't want funds taken away from them and putting into other products. It's always important to understand all the features. Again, it is a contract, and just like any contract, you have to review all the details. They can come with fees that are slightly more complicated. They can come with some restrictions to what you can do with your money. In addition to that, I think just the annuity lingo of the finance industry is continuing to evolve over time. Since this is a contract, the way that you edit a normal contract is you add riders to that. And some insurance companies might call some features something slightly different than another insurance company. So what might be a benefit base, for example, to one insurance company might be a protected base to another insurance company, making it very difficult to keep track. In addition to that, just the products over the years continue to innovate based on a response to the market and as needs of the clients evolve over time.
It's very complicated. You're right about that. Why don't we talk about the different types of annuities? There's a lot of them in the market right now, aren't there?
Yeah, definitely a lot of different types of annuities. And then as I mentioned before, they can all have different features get added onto them. So maybe starting with the foundational one, we have the general umbrella of the fixed annuity. So when you think about fixed, it is not necessarily going to be invested in the market. It's going to be based on how the insurance carrier themselves invests your money in their personal fixed account. The money is held with them. So on a baseline, I promise to pay, you might think of a SPIA or a single premium immediate annuity. So you would provide the insurance carrier with a lump sum, possibly from cash, a non-qualified account, or maybe even your retirement account, and they're going to liquidate that back to you over a series of payments for the rest of your life, over a stated period of time, or possibly even over the joint life expectancy of an individual and their spouse. That's what we would call like a payout annuity. So outside of that, you can also just put money into an annuity to get some tax deferral over time. Again, with the crediting by the insurance carrier, this would be called a fixed deferred annuity. So I'd give you $100,000 for an example, and the insurance carrier would promise to give me X rate of return for 3 years, 5 years, 10 years or more. And that money would be guaranteed in the future that you could then turn into a lifetime income stream.
Okay, are there any, well, let me ask you this as a follow-up then. Who are candidates for annuities? Who are the best candidates?
Yeah, so different candidates all look different. They can be both young and old. Typically, you're going to think of candidates being retirees or close to, at, or maybe already in retirement. So annuities can provide that income stream that almost replaces a paycheck for an individual. So think of clients that might lean on the conservative side. They don't want to trust the stock market or other investment products to provide them with income during retirement. They want to have a solid base of fixed or reliable income to pull on. However, on the other end of the spectrum, because annuities do provide tax deferral, sometimes even aggressive investors might buy into them because they have the ability to buy and sell different products, investment products within the annuity wrapper, and not experience capital gains tax or ordinary income tax when they buy and sell those. So this would be an example of a variable annuity, one of the product innovations that's happened over time.
So for most Americans, I think Social Security is perhaps their largest guaranteed income source. So by buying an annuity and having a lifetime income, you're increasing that total guaranteed income stream at retirement.
Right,
okay.
that income floor that you rely upon is so important, especially during times of uncertainty. We all know that when the market goes down, it hurts your portfolio even more if you have to take larger distributions out of that. So having a fixed income stream to fall back on can really save the longevity of a financial plan.
Are there any downsides that people should be aware of when buying annuities or looking at them?
Yeah, the downsides, or I would say some of the restrictions of the annuity, are definitely something you want to take a look at in your contract. And one of the most important reasons why you need to work with a financial advisor who knows their stuff when it comes to annuities. So every annuity is going to have, again, a very specific fee structure. So you need to make sure that that plays in well with your tolerance. There could be restrictions on access to your money. Sometimes this is called a surrender period, or a CDSC, a contingent deferred sales charge on the actual funds. So you're getting the benefit of a stated rate of return or a stated benefit, but there are trade-offs to that, and sometimes that means giving up some liquidity in the short run. I mentioned earlier, when you asked me about the turnoffs in annuities, I said it might come from some bad apples in the industry. So always look at the strength of the insurance carrier that you're buying the annuity from, because this, at the end of the day, could be the biggest negative that you realize. If the insurance carrier runs out of money, that contract is between you and them, and they have the promise to pay you. So look at the credit rating of that financial institution.
You know, a lot of clients I've found actually have access to annuities. They don't know it. If they're a government employee or a state of California employee, for example, a teacher, or work for a large company in the U.S., oftentimes their retirement plan has guaranteed income stream options in addition to a lump sum option. And basically what's happening is the company is providing an annuity for those retirees. They probably don't call it that, but that's in effect what is happening underneath the hood, so to speak.
Yeah, that's exactly right. And unfortunately, over time, as employers want to take less and less risk, they are actually shifting that from an annuity to just more of a straight investment account, what you would think of as a traditional 401k plan, they don't want to necessarily pay the higher fees or have that longevity risk of providing their clients with lifetime income. They would rather put it on you. So it's your job to go out and maybe look at the annuity marketplace yourself.
How can an annuity be a complement to other financial products in a plan? For example, a historical saver or for a retiree?
Yeah, great question. And I like how you always phrase that as it's a complement to a financial plan, because the annuity product is not going to be something you take all of your liquid net worth or all of your retirement accounts in there. It truly needs to be a complement to the other assets and to the other income sources that you've accumulated throughout your life. So for example, someone who is close to retirement may want to consider an annuity so that they can take advantage of some upside over the last maybe 5 years of their working life, but not take on huge amounts of downside, because when they start retiring, they need to start pulling that money right away. So they can't handle a black swan event, a market downturn that could be detrimental in the early years of retirement.
We all know that we've been in a very low interest rate environment for 10 years, and now we're shifting and interest rates are rising. Rates in fixed annuities have been very, very low. Are you seeing a movement towards the upside with the guaranteed rates that insurance companies are offering?
Definitely. Towards the beginning of 2022, we even started to see them price in, the Fed market rate continuing to get better and better. So insurance products in general, which includes annuities, all have been able to take advantage of that, because at the end of the day, every financial institution is going to buy the same bond no matter what. So they all have to price that into their products. So some of the fixed payout annuities that we referenced earlier are going to have better interest rates as interest rates continue to increase. And then some of the riders that you can tack on to the variable products will get better and better as well.
Excellent. Would you say that annuities are for everyone?
A good question. And whenever you use absolute words like always, never, everybody, my compliance hat goes on. So I have to cautiously say, no, I can't say that annuities are for everyone. However, because the product has become, so innovative over time, I think they fit in more and more financial plans. Again, I mentioned somebody looking for guaranteed income who might be conservative on one hand, but it could also be for somebody who's super aggressive that wants to trade in a tax deferred account. That could be another fit. So everybody, probably not, but I think you can make a strong case in a lot of financial plans.
One of the chapters in my book talks about annuities and life insurance and how those are so misunderstood.
Sure.
They're just really a tool to be used in the right circumstance. And I myself have never been an all or nothing person, and everything's an annuity or everything's in a traditional investment account. Oftentimes, a much more broad-based approach is best for the client. What about as far as advisors that are able to sell these vehicles? You mentioned fixed, you mentioned variable. Are the same regulatory requirements put upon advisors if they sell one versus the other?
Yeah, so the insurance industry is all going to be regulated by the individual state insurance department. So advisors can be held to a best interest standard when issuing different products, and they're all going to be regulated, say by FINRA or the SEC. In addition to that, it's always important to look at advisors who have additional designations that may hold them to a higher fiduciary standard, such as a certified financial planner or a chartered financial consultant.
I was thinking about, for example, fixed annuities, I think require only insurance licensing. But if you offer variable annuities, you need to also have, be a registered representative with a bona fide broker-dealer, for example. So an insurance agent licensed can only offer one versus all of them or the entire suite of annuities.
Yeah, that's certainly right. So the variable product suite of annuities definitely requires additional testing and compliance for the advisors to participate in them and offer them to their clients, because the variable, as opposed to the fixed, does have some market features that requires additional education and compliance for the advisors to offer them. However, this can be a big advantage for investors that want to have some downside protection or maybe some guaranteed income features, but still participate in the market a little bit.
Gotcha. What would you say to financial advisors who don't believe in annuities, just across the board?
Yeah, I really appreciate that phraseology, because it's something that I've heard before from maybe a traditional money manager. I just don't believe in annuities. Well, my initial response to them would be, it's not a belief system. It is, as you said, it's a financial product. It's a tool that you can incorporate inside of a financial plan. And my other response to them would be, if you don't have access, you're not properly licensed, or you don't include them in your practice, it's a unique financial tool. So how are you truly serving the best interest of your clients if you don't have any access to them at all? So maybe something to think about. And for people watching this video, it's also something to think about, as you are talking to your own financial advisor. Do they offer the full suite of products to truly address all of your needs, no matter how unique they are?
Well, that's all the time we have for today. Zach, I want to thank you for your time and expertise in helping to explain a very complicated subject called annuities. And that's all the time we have for this edition of the Prosperity Report. I'm Mark Chandick, and I thank you for watching. Thank you for tuning in to the Prosperity Report. If you enjoyed the episode, I want to offer you a free download of my latest book, 10 Financial Strategies for the Smart Investor. It's a candid view of where we go wrong with money and how to get back on track. In it, you'll discover how to avoid common mistakes and build lasting wealth. To get your free copy, first click the subscribe button you see on your screen. Then find the link in the show description below and click on that. Soon you'll be on the way to turning all your possibilities into true reality.